Welcome back to the channel, everyone. Today, we're going to recap the key topics we've covered over the past 2 weeks and reaffirm the core philosophy of this channel. So, why was this channel created in the first place? My goal is very simple: to share my personal perspectives and the knowledge I've accumulated about gold. I want to help people properly understand the role of gold in wealth building and asset protection. This is not investment advice, but rather shared insights so we can learn together and make more informed decisions. Over the past 2 weeks, we've explored many interesting topics. We've provided updates on gold prices and the US dollar exchange rate. We've also discussed the fundamental difference between spot gold traded on international markets and physical gold that you can actually hold in your hand. I also explained the inverse relationship between interest rates and gold. When interest rates rise, gold often becomes less attractive, and when interest rates fall, gold tends to benefit. One of the most important concepts we discussed is inflation. Inflation is like termites silently eating away at the value of the money you work so hard to earn. If you only hold cash, your purchasing power gradually declines over time. This is exactly why central banks around the world continue to buy and hold gold as reserves. They understand that gold has intrinsic value. Gold is not controlled by the policies of any single government. It has preserved value for thousands of years. One question I receive very often is, should I buy gold when prices are already high? My answer is this: if your goal is long-term wealth accumulation, buying consistently is more important than trying to time the exact bottom or top. Trying to time the market is one of the most common mistakes people make when buying gold. Many people rush in when prices rise out of fear of missing out. Then they panic and sell when prices pull back slightly. This approach usually leads to losses. Instead, we should think of gold as a long-term savings vehicle. So, how much gold should you buy each month? There is no fixed number that works for everyone. It depends entirely on your income, expenses, and financial goals. Start with a small amount that you're comfortable with. This could be 5% or 10% of your monthly income. The key is discipline and consistency. Recently, many people have been worried because gold prices have been moving sideways for a while. Is that something to be concerned about? In my opinion, no. Sideways markets are actually a good time to accumulate calmly without being driven by emotions. Gold is not a tech stock that skyrockets in a short period of time. Its true strength is revealed during financial crises. When other assets collapse, gold often acts as a safe haven. It helps protect your overall portfolio. Another great question is whether gold can completely replace cash. The answer is no. We still need cash for everyday expenses. Gold is a store of value, not a medium for daily transactions. So, when should you not buy gold? First, do not borrow money to buy gold. Second, do not use up your emergency savings. And finally, do not buy gold if you expect to get rich quickly in a few weeks or months. The core message I want to emphasize once again is this: gold is not meant to make you rich quickly. It is meant to protect your wealth from losing value over time. Gold fits a long-term wealth building strategy. It helps create a solid financial foundation for the future. It is not suitable for short-term trading or constant buying and selling for quick profits. All the content shared on this channel is based on my personal perspective and experience. I strongly encourage you to do your own research. Make decisions that best fit your individual circumstances. Thank you for listening and for supporting the channel during this time. If you find these insights helpful, please like the video, subscribe to the channel, and turn on notifications so you don't miss future content. Goodbye, and I'll see you in the next video.